You can do everything right in your own life. You work, you save, you keep some cash in the bank. Then, almost overnight, the prices of imported food, fuel, and rent explode. Your salary is the same on paper, but the currency it is paid in is suddenly worth far less. That is what a devaluation feels like from the inside. It often arrives dressed up as a technical adjustment or a necessary reform. But by the time the official announcement comes, the damage has already been done. The real story started years earlier when a handful of quiet indicators began to shift. Take Mexico in the early 1990s. On the surface, the country looked like a rising success story. Growth had picked up, foreign investors were excited, and the currency appeared stable. Yet underneath, the current account deficit had swollen to a level equal to roughly high single digits of national output. The country was importing much more than it exported and filling the gap with foreign capital. At the same time, the central bank's foreign exchange reserves were being drawn down sharply as it tried to defend a semi-fixed exchange rate. The government also issued a large pile of short-term bonds that were effectively indexed to the dollar. To the average household, none of this looked alarming. The exchange rate stayed in its official band. The banking system still worked. But the pattern was already locked in: a fixed or tightly managed exchange rate, large external deficits, rising short-term foreign currency debt, and shrinking reserves. By late 1994, the authorities were forced to devalue. The peso slid, interest rates shot up, and what had looked like a stable path suddenly turned into a deep crisis. The important point is this: the crisis did not begin on the day of the devaluation. The crisis began when those underlying pressures started to build. By the end of this episode, you will understand that pattern in plain language and know where to look for it long before the headlines talk about shock devaluations. Let us set up the basic concepts in simple terms. A currency crisis is what happens when a country can no longer defend the value of its money against others. A devaluation is the official recognition of that failure. In a fixed or tightly managed system, the government or central bank promises an exchange rate. To keep that promise, they must be willing and able to buy and sell foreign currency, usually dollars or euros, using their own reserves. A normal, steady-state situation looks like this. Trade and capital flows move in both directions. The country may run small surpluses or deficits, but they are manageable. Foreign exchange reserves grow over time, or at least stay stable, relative to the size of the economy and short-term external debt. Domestic credit grows at a healthy but not explosive pace. The real exchange rate, meaning the local currency adjusted for inflation relative to trading partners, does not drift too far away from its long-term average. A dangerous pattern is different. You see three elements come together. First, the currency is held at a fixed or very narrow band while domestic prices and wages rise faster than in trading partners. This makes the currency overvalued in real terms. Exports become less competitive, imports become cheap, and the trade balance deteriorates. Second, the country fills that gap with external borrowing and hot money inflows rather than with long-term patient investment. Short-term dollar debt of the government, banks, and corporates grows quickly. Third, foreign exchange reserves stop rising and begin to fall, just as external debts and obligations are still increasing. The ratio of short-term external debt to reserves climbs. The central bank is using its war chest to defend the peg, but each month it has less ammunition. This combination breaks the real economy because it is not sustainable. At some point, creditors and investors doubt that the country can meet its obligations and maintain the same exchange rate. When they pull back or hedge aggressively, the authorities face a choice between brutal interest rate hikes, capital controls, or a devaluation. Often they end up using some mix of all three. Before we go deeper, a quick word from me personally. I have spent more than 12 years focused on currencies, crises, and sovereign risk. My work has involved analyzing exchange rate regimes, banking systems, and external balances for institutional clients and research groups across different countries. I am not here to sell you a newsletter, a secret signal service, or a doomed subscription. The goal of this channel is simple. We deal in patterns backed by data, not rumors or clickbait. What you are hearing is education, not financial advice. You are responsible for your own decisions. My job is to help you see how these systems usually break long before they officially snap. With that out of the way, let us move into the evidence. The Mexico story was not unique. Very similar shapes appeared in other currency breakdowns. Look at Thailand in the mid-1990s. For more than a decade, Thailand enjoyed rapid growth with low inflation. The baht was pegged to a basket of currencies but effectively anchored tightly to the dollar. On paper, it looked like a stable system. In the early phase, easy external financing and confidence in the peg led to a flood of foreign capital. Banks and corporates borrowed in foreign currency at lower interest rates. A large share of this money went into domestic credit expansion and real estate, pushing up property prices and construction. The real exchange rate appreciated, meaning Thai costs rose faster than those of trading partners. As this went on, the current account deficit widened and short-term external debt piled up. Critically, the structure of that debt was dangerous. A large portion was short-term and denominated in dollars, while the earnings to pay it back depended on a domestic economy that now needed continuous inflows to stay afloat. The pre-crisis shift showed up in the external indicators. Official foreign exchange reserves stopped keeping pace with external debts. The ratio of reserves to short-term external debt fell to levels that would later be judged inadequate even by conservative rule-of-thumb measures. Speculators tested the peg with attacks in the spring of 1997. By early July of that year, authorities could no longer defend the fixed rate and the baht was floated. The visible crisis came after that decision. The baht fell sharply, equity and property prices dropped, and highly leveraged firms and banks were exposed. Layoffs and closures spread from finance to construction and beyond. From the outside, it looked like a sudden disaster. From the point of view of the data, the pattern had been building for years. Moved to Argentina in the late 1990s and early 2000s. For about a decade, the country operated under a strict currency board-style system, with the peso fixed 1-to-1 to the dollar. Initially, this brought down inflation and restored some confidence after earlier hyperinflation episodes. But over time, the same familiar stresses appeared. The fixed rate made it hard to adjust to external shocks. As the dollar strengthened globally, Argentina's competitiveness eroded. Domestic prices and wages adjusted slowly, while the real exchange rate became increasingly overvalued. Fiscal deficits and rising public debt added pressure. The pre-crisis period was marked by capital outflows and rising sovereign spreads. Reserves came under strain as the authorities tried to defend the peg. Banks were exposed through deposits and loans linked directly or indirectly to the fixed conversion rule. As confidence fell, depositors began to withdraw funds. The visible phase arrived when the government imposed withdrawal restrictions, the so-called freeze on bank deposits, and later abandoned the 1-to-1 peg. The peso devalued heavily, real incomes fell, and the banking system was forced through a painful restructuring. Again, households experienced this as sudden disruption. But the underlying structure, an overvalued fixed exchange rate, weak fiscal position, rising debt, and reserve pressure had been in place long beforehand. Across these episodes, the repeating shape is clear, a period of apparent stability and inflows under a fixed or tightly managed regime. A build-up of external imbalances and foreign currency debt, a phase where reserves quietly failed to keep up with obligations. Then, when confidence cracks, a rapid move from defense to devaluation and often broader financial crisis. So how exactly does this pattern break the real economy step by step? Start with the policy choice. A government fixes or heavily manages its exchange rate, often to anchor expectations and attract capital. This can work for a while. But if domestic credit grows too fast, if fiscal policy is loose, or if wages rise faster than productivity, the real value of the currency drifts higher than fundamentals justify. An overvalued currency means exports struggle and imports are cheap. The trade balance deteriorates. Instead of adjusting the exchange rate, the country often covers the gap with foreign borrowing. Banks and corporates find it tempting to borrow in dollars or other hard currencies because the interest rates are lower and the exchange rate is assumed to be stable. As this continues, short-term external debt rises relative to the size of the economy and to foreign exchange reserves. The central bank keeps intervening to keep the currency at the promised rate, selling foreign currency when there is pressure. Reserves begin to trend down, but on the surface, not much seems to change for households. The next link in the chain is confidence. Once investors, lenders, and even domestic savers begin to doubt that the peg can be maintained, They look at that ratio of reserves to short-term obligations and worry. They start to shorten maturities, demand higher interest rates, hedge currency risk, or quietly move funds out. This shows up in rising spreads, episodes of capital outflows, and more frequent central bank interventions. At some point, the central bank has to choose between tightening monetary policy sharply or allowing the currency to move. If it hikes interest rates aggressively to defend the peg, domestic borrowers come under stress. Banks see non-performing loans rise. If it hesitates, the pressure shifts directly to the exchange rate and the reserves. Once reserves fall below certain informal comfort levels relative to short-term external debt and imports, the market effectively tests the peg. Speculative attacks become more frequent and intense. The authorities may respond with partial devaluations, temporary capital controls, or new guarantees, but these often signal that the old regime is no longer sustainable. Finally, the country moves to a full devaluation or a free float at a much weaker rate. Foreign currency debts becomes more expensive in local terms. Banks and corporations with unhedged exposure see their balance sheets hit hard, credit tightens, investment falls, and unemployment rises. The household sector that never tracked current account charts or reserve adequacy ratios suddenly experiences the end of that pipeline as job losses, higher prices, and frozen access to credit. This is why currency crises are so destructive. They are not just about a price on a screen. They are about a sequence that starts in the external accounts and ends in everyday lives. Let us break down what this usually means for normal households in plain language. First, jobs and income. When a devaluation follows a period of credit-fueled growth, the tightening phase is brutal. Companies that borrowed in foreign currency or relied heavily on imported inputs see their costs jump. Some cannot roll over their debts at reasonable rates. Projects are canceled, hiring stops, and layoffs follow. In Thailand, after the baht was floated, there were mass layoffs in finance, real estate, and construction, and many workers were forced to leave cities and return to rural areas. In Argentina, after the end of the currency board, unemployment and underemployment rose sharply as firms struggled to adjust. Second, housing, mortgages, and credit. In many of these episodes, property booms preceded the crisis. Easy credit in the good years pushed up land and housing prices. When the currency breaks and rates spike, the credit machine reverses. Banks tighten lending standards or stop new mortgages altogether. Household borrowing costs rise. If mortgages or business loans are directly or indirectly linked to foreign currency, the burden in local terms can become crushing. Developers stop projects, and property prices can swing from overheating to deep discounts, trapping highly leveraged households. Third, savings, investments, and retirement. If most savings are held in local currency deposits or domestic bonds, a sharp devaluation reduces their external purchasing power immediately. In severe crises, authorities may restrict withdrawals, convert deposits at forced rates, or restructure local currency debt. Equity markets often fall in tandem with the currency, especially when corporate balance sheets are exposed to foreign currency liabilities. For people close to retirement, a currency crisis can destroy years of planned purchasing power in just a few seasons. Fourth, social and political stress. Currency crises rarely stay within the realm of finance. Rising unemployment, falling real wages, and a sense of betrayal when official promises break can trigger protests and political upheaval. In several episodes from Asia to Latin America, you see a pattern of government turnover, emergency legislation, and institutional strain following major devaluations. This environment makes policy less predictable and adds another layer of risk for households trying to make long-term plans. So, the pattern is not abstract. It hits jobs, homes, savings, and the social contract itself. Now, what are the concrete signals you can track before a devaluation without trying to become a full-time analyst? Think in terms of a short checklist of structural stress points. Signal 1, a fixed or tightly managed exchange rate with a growing gap between domestic inflation and that of key trading partners. If a country insists on keeping its currency pinned while its prices rise faster than those abroad, it is quietly making its exports less competitive and imports more attractive. Over years, that tends to show up as a persistent current account deficit. Signal 2, large and persistent external deficits financed by short-term capital inflows. If the gap between what the country imports and exports is being closed mainly by hot money and portfolio flows, rather than by long-term direct investment, the funding can vanish quickly under stress. Signal 3, foreign exchange reserves that are stagnant or falling relative to short-term external debt and to the value of imports. Professionals look at ratios like short-term external debt over reserves and months of import cover. You do not need to compute fancy formulas, but you can pay attention to whether reserves are falling steadily while the authorities still promise a rigid exchange rate. Signal 4. Rapid domestic credit growth and asset price booms, especially in property, in the years leading up to pressure on the currency. Many studies and historical episodes show that credit booms, banking fragility, and currency crises are tightly linked. When banks expand lending aggressively, particularly if funded from abroad, the system becomes more fragile when conditions turn. Signal 5. Official denial combined with increasingly ad hoc policy measures. In several past crises, there was a phase where authorities insisted there would be no devaluation while simultaneously tightening capital controls, offering special guarantees, or restructuring short-term debts. That combination of strong verbal commitment and growing financial engineering is a classic late cycle sign. In history, these signals often stayed distorted for 1 to 3 years before the visible crisis hit. Professionals use that window not to call the exact day of the devaluation, but to adjust exposures. That leads to the final contrast. Large actors, governments, central banks, major institutions, and sophisticated investors tend to behave very differently from normal households in this phase. They monitor external accounts and reserve positions. They shorten maturities, add hedges, diversify into foreign assets, or quietly reduce exposure to the vulnerable currency. They know that the trigger sequence is already underway the moment those structural ratios move into dangerous territory. Retail investors and households, on the other hand, often focus on the headline exchange rate and local stock prices. As long as the peg holds and markets are calm, they assume everything is under control. By the time they react, options are limited. Withdrawal limits, capital controls, and forced conversions close many doors that were open in the quiet build-up period. Your edge is not in being smarter than those players. Your edge is in understanding that behavior and structure matter more than short-term forecasts. Let us close by stepping back to mindset and boundaries. My role here is not to call day trading entries or tell you which currency will move next. My role is to help you see the structures that make crises almost inevitable when certain conditions line up. Everything you have heard is education, not financial advice. Use it as one input among many, not as a signal to rush into or out of anything. So how do you turn this pattern into protection instead of just fear? First, think about your personal balance sheet. Currency crises punish people who are heavily exposed to a single, fragile system with no buffers. That can mean too much short-term floating rate debt in a vulnerable currency, no cash cushion, and no diversification of income or assets. Resilience means gradually reducing fragile exposures, avoiding debts that would explode under higher rates or a weaker currency, and building some flexibility in how and where you hold your savings. Second, build an information habit around the right indicators. You do not need to follow every data release, but you can pay attention to a simple dashboard. Is the country running large and persistent external deficits? Are foreign exchange reserves rising, flat, or falling? Is the exchange rate rigid even as inflation and credit growth outpace peers? Have rating agencies, international institutions, or serious research outfits begun to flag reserve adequacy or external debt concerns? Checking these a few times a year puts you in a very different position from someone who waits for the official surprise announcement. Third, cultivate emotional and strategic discipline. Currency crises are designed, in a sense, to trigger panic and complacency at the worst times. In the build-up, there is complacency. People assume the peg is safe because it has held so far. After the break, there is panic. People rush into whatever seems safe in the moment, often at terrible prices. Your job is to avoid both traps. You want to act in the quiet periods when the structural signals are flashing, but the crowd is still asleep, and to avoid impulsive, all-or-nothing moves when volatility is at its peak. If you take nothing else from this episode, take this. Currency devaluations are almost never true bolts from the blue. They follow a typical trigger sequence: an overvalued fixed or tightly managed exchange rate, financed by external borrowing, defended with shrinking reserves, and finally abandoned under pressure. You have now seen that pattern play out in different decades and regions, and you know the key variables professionals watch. That does not make you invincible, but it does mean you are no longer blind. You have one more concrete tool in your crisis pattern toolbox: how to recognize the stress building in a currency regime before the official devaluation hits your job, your savings, and your plans. In the next episode, we will go one link further down the chain. We will look at how currency breakdowns often feed directly into banking stress and capital controls, and what that means for anyone who still believes their deposits are always safe and liquid no matter what happens to the exchange rate.